Ann Simpson, Managing Investment Director for Board Governance and Sustainability at CalPERS. Samantha Ross, founder of Assurance Mark. Greg Rogers, founder of Eratosthenes. And Natasha Landell-Mills, Head of Stewardship and Partner at Saracen Partners, will explore the importance of commodity price assumptions to balance sheets of energy companies. They will discuss if there are critical omissions in accounting disclosures across the energy sector that investors should see, and provide insights about asset retirement obligations that could be hidden, yet significant risks on the balance sheet. So Ann, thanks for kicking off this session, and over to you.
Well, hello everybody, and thank you to Ceres for inviting me to join you to talk about a topic that nobody ever thought would become quite so exciting and important, and that's accounting and audit. And the question I want to answer is, why does this matter to a pension fund like CalPERS? We've long been members of Ceres. We understand that climate change poses both a systemic risk to our portfolio, but it's also climate change is bringing all sorts of opportunity to us. And our strategy has got three parts. We talk about advocacy with regulators, engagement with companies, and then integration, where we take what we understand about climate risk and opportunity into our investment decisions. Now, that's all well and good. How do we know what to do, how to do it, when to do it, where to do it when we're considering climate risk? Well, we need information. And what we've decided some while ago is that we can't just rely on a collection of voluntary best practices on reporting. So think about it like food labeling. You go into the supermarket, all these tins are on the shelves, and essentially what you want to know is what's in the tin. And if you don't have labeling on the tin that tells you about the ingredients, the quantity, the amount, the sell-by date, and then have some safety standards around what's good for you, what's not, what might cause problems, we just take it for granted that when we buy something, we have to know what's in the tin. And it's exactly the same with getting climate risk onto the accounts for companies. We need to know the drivers of risk, and we need to know about the opportunities. So the best practice world has done fantastic work for us in building out ideas and standards and frameworks, but we need to get this integrated into the financials, because otherwise the allocation of capital and the exercise of stewardship are not really being supported by the data, by the evidence, by the information that we need. And that is the lifeblood of markets. So it's a simple request. It's not just disclosure, it's accounting and audit, so that we have high quality disclosure upon which we can make decisions.
Hi, hello. My name is Natasha Landell-Mills, and I'm a partner and head of stewardship at Saracen Partners, which is an asset management firm based in London. I've been invited here to talk to you today about some of the work we have been doing to drive a Paris-aligned accounting in the UK and Europe. It's a subject that's very close to my heart, and I'm very pleased to be able to share some of this work with you. So you already heard from Anne a little bit about the importance of Paris-aligned accounting. At a very high level, essentially, you know, the goal here is to ensure that capital is being allocated in a way which is aligned with the Paris goals of keeping temperature increases to well below 2 degrees and ideally 1.5 degrees. And if you think about it in a very kind of basic, in very basic terms, capital is either being allocated by investors into companies, or the companies, of course, are allocating capital themselves into projects, as I've put up on this slide. At both levels, the accounts are driving that decision-making, and that is why making sure those accounts are giving out the right signals and embedding climate risks is so important. To try and bring this to life a little bit and explain how that actually works in practice, what I'd like to do is just run through quite briefly a hypothetical example of a coal-fired power company. What I'm going to do is basically highlight to you two sets of accounts. In the first set of accounts that I have coming up now, these accounts ignore decarbonization. So they ignore climate risks associated with getting onto a Paris pathway. I'm going to then compare it to a set of accounts that actually take into account decarbonization. So in the first set, you have this coal-fired power company, and because it's ignoring decarbonization and the goals of the Paris Agreement, you're depreciating your assets over, say, 30 to 50 years, and that takes you well beyond a 2050 deadline. At an asset value level, you're assuming that you've got rising power demand into the future. There's no constraints on that demand because, as I say, Paris doesn't exist, and therefore those asset values are secure. At an asset liability, from a liability perspective, an asset retirement obligation. So those liabilities associated with the cleanup costs at the end of the asset's life, well, those are into the distant future because, as I say, the life of that asset is actually very long. That means at an accounting level that your profits are going to be higher because you have a lower depreciation cost and you won't be impairing any assets. And those liabilities are into the future, so you don't need to make any provisions. So in a sense, you're reporting what I would describe as potentially mythical profits and over-optimistic capital levels, which of course drives reinvestment into coal. On the other hand, if you have these Paris-aligned accounts, that depreciation charge will be higher because your asset life is shorter, so every year you'll have to expense a higher amount. The asset values, likewise, the cash flows are far less secure, and in some cases you will be impairing assets, pushing down your profits and your capital, and then the asset retirement obligations will be sooner. So that liability will be sooner and you'll be provisioning more every year, again, reducing profits. So that entity, the same entity, taking into account the Paris Climate Agreement, will look much less profitable and far less well capitalized, and in some cases it may actually be insolvent. So in essence, what you have there is a mechanism for ensuring you're not reinvesting good capital into fossil fuel activities that actually do not have a future. You're lowering effectively your stranded asset risk. So until the numbers are aligned with Paris, hopefully that helped you see that capital deployment will not be aligned with Paris. So what have we been doing? On this slide, what I try to do is bring out some of the key actions that we've done, but also the impacts that we've had primarily in Europe today. One of the hooks, if you like, for this work has been the TCFD. TCFD has been driving far better narrative disclosure around climate risks, as well as strategic disclosure and governance. But the problem with it is it has left out this very important accounting dimension. So what we've been trying to emphasize is that alongside TCFD, companies and regulators should be ensuring that those accounts are aligned with Paris. So some of the things that we have done in January 2019, we wrote to the big four audit firms in the UK to say that we expect audit firms now to be looking at whether climate risks are embedded into those accounts. We also initiated a number of company-specific engagements, Shell, Total, BP, CRH, Rio, and Eni are some. And we had outreach to various standard setters like the International Accounting Standards Boards and regulators as well. Most recently, we sent letters to 36 European companies in November of last year, and now we're getting responses back from them. And those letters were signed by investors with assets of over 9 trillion, asking for Paris-aligned accounts. So what has that resulted in so far? I'm going to come on to some company-specific results, but we've had regulatory responses. The FRC in the UK has now set out its expectation that material climate risks are being considered as companies publish their annual report and accounts. The International Accounting Standards Board put out a very important guidance note back in November 2019 and has reiterated that in 2020. Talking about how climate risks are absolutely relevant to international financial reporting standards accounts. I know that Sam is going to come on to talk to you about the relevance of this for the US, but that applies to companies in most of the international markets globally. We've also had the International Audit and Assurance Standards Board publish a set of guidance saying that auditors globally need to be taking account of climate risks as part of the audit processes. So let me just give you one example of an engagement that we've had over the past couple of years. This is with BP. we had been engaging with BP since 2016, but it was in November 2019 that we drew together a broader coalition of about 1 trillion of AUM to specifically zero in on this issue of Paris-aligned accounting. So we wrote to the audit committee chair and we copied that letter to the auditor, in that case, Deloitte. And we had quite surprising impact, and it was quite a quick impact as well. It was in their 2019 annual report that was published in the spring of 2020, where Deloitte included climate risk as a key audit matter. So effectively, they were calling out climate risk as one of the key areas of judgment that had a very material bearing on what those reported accounts were telling investors. And they specifically, and this is one of the first times I've ever seen an audit to do this, they specifically called out commodity price assumptions as not being consistent with Paris. Effectively, they answered our call for the auditor to alert investors where there were issues. What was then very interesting is that just a few weeks later, in June 2020, BP issued a press release to say that going forward, it would then lower its commodity price assumptions due to decarbonisation to be aligned with Paris. And as a consequence of that, they will be recognising an impairment of between 13 and 17.5 billion. So almost 20% of their equity. So this was really very significant. And I was not particularly surprised, though there are a number of drivers for this, that it was shortly after that that they announced their strategic overhaul and much more robust measures to bring down over the long term their fossil fuel production. And the reason I say that is that if the accounts are telling you that reinvesting in fossil fuels is less profitable, then executives will invest less into fossil fuels, a little bit like the coal power example I gave you earlier. So what does this case study of BP tell us? It tells us that climate change has material impacts for accounts, clearly. It tells you also that the accounts can be aligned with a net zero pathway. It's absolutely possible to do, and that they can actually do it quite quickly. It tells you also that the auditor has a very vital role here in alerting shareholders where the accounts are not Paris aligned. And it shows you finally that when you do adjust those accounts, that strategic changes and CapEx changes then follow. So it's a really, really important proof point for why getting the accounts aligned with Paris is so important. Let me just touch now briefly on this investor expectations document. Following the success with BP, but also Shell and Total, we had similar engagements. We came together with our IGCC to publish an investor expectations document for Paris-aligned accounts and audits. This is just a picture of it here. It was supported by over 9 trillion in AUM, and it was sent to 36 European companies. And I mentioned that earlier. We are now getting responses from these companies. It's helpful, I hope, because it sets up very explicitly 5 expectations for directors listed here, as well as 4 expectations for what auditors need to do. And based on those very clear asks, now we have set out some ideas for voting consequences, and in particular holding the audit committee to account through votes against potentially, as well as holding the auditor to account, because of course we have a vote for the auditor reappointment every year in most jurisdictions. And finally, there are investment implications of potential overstatement of capital. So let me conclude. Paris-aligned accounts are clearly necessary to ensure capital supports a net zero pathway, whatever the jurisdiction. Auditors here play a critical role. Auditors should sound the alarm when accounts are not calibrated for a net zero pathway. And shareholders have a number of actions that they can take. Engaging with audit committees as well as with auditors, voting against audit committees, directors and auditors, as I've just mentioned, where the Paris test is not met, and indeed potentially filing shareholder resolutions calling for directors to publish Paris-aligned accounts. There's also the potential, or arguably the need, for regulatory action requiring mandatory inclusion of Paris-aligned scenarios or sensitivities in financial statements. We're not there yet, but as governments take on statutory targets for net zero, it would be a very logical step for governments to align the accounting requirements with that. So I'll stop there. Thank you all very much for listening and happy to take questions later.
Hi, I'm Samantha Ross, founder of Assurance Mark. Now, Natasha spoke to how UK and international accounting standards apply to climate risks and to the great strides that investors have seen in UK oil and gas companies' accounting and disclosure. I want to talk now about US disclosure and accounting requirements and Ceres' new report, Lifting the Veil. The SEC issued climate disclosure guidance more than 10 years ago, but it's not really been enforced. Last month, acting SEC Chair Allison Lee announced that she had directed the staff of the Division of Corporation Finance to enhance its focus on climate-related disclosure. That's going to be tremendously useful. What we've done in the Lifting the Veil report is take a close look at existing US accounting and disclosure requirements, specifically in the oil and gas industry, and walk through how climate risks bear on those requirements. This is meant to be similar to the work authorities have done internationally to explain how climate risks apply to international financial reporting standards, as Natasha described. We looked at US accounting standards, which actually are pretty analogous in the most significant areas. That's because we're not talking about arcane areas of accounting and disclosure. As with the international guidance, there are some basic, long-standing accounting and disclosure principles that are universal. All we've done, like the international guidance, is apply those principles to climate-related financial risks. So let's get into the report. The report includes 4 broad expectations, which I'll go through, but I'm going to really focus on the first 2. The first expectation goes to accounting itself. Oil and gas companies' financial statements should be clear about the impacts of climate change and the energy transition on their financial results and position. As Natasha explained, climate impacts are pervasive throughout the financial statements. The report explores several specific topics. So starting off, the sensitivity of estimates. US generally accepted accounting principles require discussion of estimates when it's reasonably possible that the estimate will change in the near term and the effect of the change will be material. The estimate of such an effect must be disclosed. Financial accounting requires numerous estimates about the future. Estimated future cash flows underlie numerous current asset valuations, for example. That's a very basic concept. There's nothing really new about it, but climate change and the energy transition significantly increase the number and range of estimates that may have to continually change. In the oil and gas industry, ultimately, the expected future benefits that an entity is attempting to obtain through its acquisition, exploration, and development activities are represented by what we call oil and gas reserves. Under the US accounting standards, proved oil and gas reserves are those quantities of oil and gas that can be estimated with reasonable certainty to be economically producible from a given date forward. That economically producible standard means you don't just go on geologic and engineering data. You have to then assess whether producing what the engineers have estimated is in the ground can be produced economically with reasonable certainty. That obviously takes into account the cost of producing those specific reserves wherever they are. And in an economic system where many governments are deliberately making policy changes to shift demand by taxing or otherwise limiting greenhouse gas emissions, we argue that associated emissions, the cost of those emissions, should also be taken into consideration. Now, once you've valued an asset, such as proved reserves on the company's balance sheet, US generally accepted accounting standards require that long-lived assets or groups of assets be tested for recoverability whenever events or changes in circumstances indicate that their carrying amount may not be recoverable. That means if you've been carrying an asset at a certain value on your balance sheet, you need to periodically consider whether changes in circumstances mean the asset no longer has that value. We hear about great swings in oil and gas prices every day. Those kinds of swings can, but don't usually affect long-term asset value. But estimates of long-term future prices, which go into estimates of future cash flows that underlie nearly everything in the financial statements, those long-term prices can affect the carrying value of an asset. This is called impairment testing. We've seen a lot of companies announce permanent impairments and asset write-downs over the last year. More is likely to come. One of the most significant factors in these impairments is changes in assumptions about long-term future oil and gas prices. Some companies have specifically tied their write-downs to their climate strategy focused on the Paris Agreement or a net zero ambition. But even companies that have not announced such commitments are still affected by the same changes in long-term prices. The prices are not unique to the companies, even though each company must come up with reasonable assumptions about long-term prices for their accounts. And those assumptions are, of course, audited. Now, in addition to estimating the value of an asset, a company also has to estimate its useful life. An asset's useful life is the period over which an asset is expected to contribute directly or indirectly to future cash flows. That is then the basis for current depreciation expenses. A change in the estimate of an asset's life, how long into the future the company will use the asset, can have a big impact on current depreciation. As I discussed with impairments, climate goals may require retirement of assets related to high greenhouse gas emissions, whether from production or consumption of the product, earlier than originally planned. As with impairments, it's not just the company's goals that matter. Government policies and the climate goals of other parties in the company's value chain and the energy transition can all have an effect on estimated future cash flows, which may also mean retirement of certain assets earlier than originally planned. Earlier estimated retirements, say from 2070 to 2040 to meet net zero by 2050, can have a significant knock-on effect of increasing current depreciation expense. Speaking of asset retirements, the last topic, accounting topic I'll cover is asset retirement obligations. Greg will go into this in a lot more detail, but essentially oil and gas companies have obligations to close up wells, remove equipment, which they must book as soon as they know they have that kind of obligation. That's a future obligation, but once they know they have that obligation, they've got to book it. Well, bringing those obligations forward because of climate-related policies and changes and decisions about how long an asset will be useful can have a significant effect on the financial statements. So that's accounting. The second expectation relates to the narrative reporting that accompanies financial statements, or the front end of the annual report. The narrative portion of oil and gas companies' financial reports should include robust discussion of the effect of climate change and the energy transition. A basic requirement in this portion of the annual report is a description of the business, including the company's strategies. We argue that this should include the role of climate in the business, and that the framework set forth by the Financial Stability Board's Task Force on Climate-Related Financial Disclosures is a good framework for a company to use. The task force went through an enormous exercise to identify material climate-related financial disclosures. They are designed to provide a through line to the financial statements, and thus they belong in the document intended to provide context for the financial statements. Companies are also required to include in their annual reports management's discussion and analysis of the financial statements. This section is intended to give investors a good understanding of the quality of a company's earnings, that is, the repeatability of the earnings. This requires disclosure of trends and uncertainties that may mean current earnings will or may not be repeatable. It also means disclosure of critical assumptions that underlie the financial statements, as is required by longstanding SEC guidance on narrative reporting. SEC rules also require MD&A to discuss liquidity and access to capital. Many banks have recently made public commitments to reduce their financing of activities that produce greenhouse gas emissions. A coalition of financial institutions called the Partnership for Carbon Accounting Financials, for example, has developed a standard for institutions to measure and report on the emissions associated with their portfolios. Also, bank supervisors are incorporating climate risks into stress testing of bank portfolios. All this means that lending, whether short-term or long-term credit, or any other kind of lending, may not continue as usual for oil and gas companies. MD&A requires companies to address this. Banks will be asking companies for reporting on their emissions, scopes 1, 2, and 3. Some oil and gas companies don't report on scope 3 emissions yet, so this brings emissions disclosure into the picture. Now, let me turn to the third expectation. The third expectation is that audit committees should reinforce rigorous consideration of climate-related impacts on financial reporting and provide for robust audits. Wherever a board locates oversight of climate policy, whatever board committee is centrally in charge of climate policy, audit committees still have a tremendous power to support those policies through interactions with management and the auditors. The report discusses what audit committees can and should do. And that leads to the fourth expectation, which relates to the auditors, who of course are critical to all the other expectations as well. The audit committee is in charge of the relationship with the auditor. Given the financial impact of climate risks, audit committees should ensure that the auditor has sufficient scope to examine them, including the measurement and impact of greenhouse gas emissions that may affect the financial reporting, scenario analysis to support robust impairment testing, any carbon offsets the company uses, progress on science-based targets, and key TCFD metrics, which after all are financial in nature. So that's a summary of the report. I really appreciate the chance to describe it, and I hope that readers find it useful.
I am Greg Rogers. I'm an environmental attorney and a CPA, and I've been writing about environmental liabilities for the past 20 years. Let me start by saying that the oil and gas industry is unusual in that it has a very large non-contingent legal obligations to decommission and reclaim its physical assets at the end of their useful life. These asset retirement obligations, or AROs as accountants call them, include plugging oil and gas wells, decommissioning offshore platforms, removing pipelines, and cleaning up contaminated refineries. The financial risk to investors and creditors comes from information asymmetry, arising from three main sources. First, large amounts of AROs are off balance sheet, either because firms decide that they cannot reasonably estimate these liabilities or because they are estimated too low. Second, cash outflows to settle AROs may occur much sooner than anticipated. Companies predictably seek to put off settlement of AROs as long as possible. But the energy transition could cause them to accelerate in a vicious cycle. Just as the energy transition impairs the value of oil and gas assets and causes them to be prematurely retired, AROs will come due sooner than expected. Acceleration of AROs can in turn cause more and larger asset write-downs. In the past year alone, the industry has recorded over $100 billion in asset impairments. Third, the industry's AROs are almost entirely unfunded and unsecured. State and federal energy regulators hold just pennies on the dollar in surety bonds, and the industry has no 401k retirement savings. The ugly truth is that the industry can't afford to retire. Recognized AROs, those that are estimated and reported, are a material line item on the balance sheet of every oil and gas company. They are also extremely material in aggregate. For example, Carbon Tracker has estimated that it will cost $280 billion to plug 3.8 million unplugged onshore US wells. That estimate excludes offshore decommissioning costs and surface reclamation costs. The problem isn't limited to the long abandoned wells drilled 50 to 100 years ago. Consider the US shale boom that started in 2004. The sector has failed to produce free cash flow, and that's before retirement costs. In other words, most shale wells can't afford to fund their own burial. Shale wells are deeper and cost more to plug than conventional wells. Only 4% of shale wells have been plugged today. Shale wells have rapid production decline rates, and therefore continual drilling is required to maintain existing production levels. More wells means more AROs. Drilling requires fresh capital, mostly debt, which was tightening before COVID and has tightened further since. The Biden administration has indicated that the US must transition from oil and has warned that industry must pay to clean up its mess. It recently suspended fracking on federal lands. The impact of AROs on firms, governments, and the financial system as a whole could be significant and unexpected. Firm managers undoubtedly hope to escape financial responsibility for AROs if and when the industry goes bust. And many investors may also expect that these costs will eventually be socialized. But companies and investors may be unpleasantly surprised. States don't have the money to bail out the industry's environmental debts. This means investors are effectively in competition with state governments for a shrinking pool of assets to cover the sector's financial and environmental debts. Moreover, in the United States, states may soon be in competition with each other, as many financially distressed producers operate across state lines. There is a race, and if states snooze, they will lose. The only entity with the money to pick up the cost for oil-field AROs is the federal government. And Democrats are indicating that any funding to states for plugging orphaned wells is likely to be conditional on full bonding, which would significantly increase the industry's cost of ARO credit. Because ARO risks are so material and potentially volatile, it's important that investors understand the key assumptions underlying these critical accounting estimates, including, first, what obligations are excluded because firm managers claim they cannot reasonably estimate the remaining useful life of the assets, which is almost always the case for midstream and downstream assets. Forget about discounting. Investors should want to know what it would cost to settle these AROs if the assets had to be shut down and cleaned up today. Second, what is the undiscounted liability for the discounted amounts shown on the balance sheet? High discount rates and long discount periods can make giant obligations seem small. Third, what are the underlying cost and timing assumptions? How accurate have these assumptions been in the past? And how susceptible is the company to ARO acceleration? Finally, how much does the company have in ARO surety bonds to cover its AROs? Today, U.S. oil and gas companies disclose none of this information, hence the risk of investors being caught off guard. That's it for me. Thank you for joining today. If you have any questions, enter them in the chat box and I will try to respond.
So thank you to everybody who's made such wonderful contributions to now what we realize is that very exciting and very urgent topic of accounting and audit. So when we're thinking about climate change, accounting and audit are going to be central to us actually moving the money in a way that's needed to address this risk, but also to find the opportunities, because it's addressing that risk, finding the opportunities that generates the investment returns. That's our day job as a pension fund. 55 cents of every dollar we pay comes from investment returns. So what happens in terms of risk and return on climate change is really important to all fiduciaries, not just to CalPERS. So that leaves the question of what is to be done? What do we need to do on accounting and audit? And CalPERS' view is there's two things that we have an opportunity to really make a difference on. The first is in our advocacy with regulators. The SEC is standing ready to roll on ensuring enforcement of the guidance that was issued many years ago. And thank you to Ceres, because you led the charge here, to make sure that climate risk was reflected in risk reporting at the SEC. But it's not only that. We need investors to say, thank you, enforcement's one piece. Second thing, we need guidance, because existing accounting and reporting requirements reference the drivers of value, reference the sources of risk, and we need to start putting climate change into the mix when we consider that. Think about things like impairment. write-downs, amortization. This all sounds very technical and boring, but this is really helping you understand the value of assets and the sustainability of the flows that are attached to those assets, the payments. The third thing we want regulators to be looking at is where we need to plug the gaps, those labels on the tin with the bits missing. So this is the standard setting piece. And there's been great work done through frameworks like the TCFD, by groups like FASB and others working for stakeholders like GRI. There's an abundance of tremendous work to build on here. But the Regulation SK project at the SEC, all eyes are on this to see not only how issues like climate change are going to be addressed, but also vitally important issues like human capital management. So for CalPERS, we're not just a one-trick pony looking at climate change, we're thinking about sustainability around financial, human, and physical capital. And with that holistic approach to investment, we need a reporting regime that goes with it. The second thing that we all need to be doing as investors is integrating this discussion into our engagements with companies. So that means looking at the quality of reporting that we're getting through the report and accounts, which in many markets we're asked to approve or to receive. There's a vote there. That needs to be considered in light of climate risk reporting. We're not big fans of this idea of a say on climate because we already have a say on the report and accounts. We also have a say on the audit committee and the board of directors. And the focus on board accountability is the next logical step in the engagement evolution for investors. And this also brings into the frame the vote on the auditors. We need to see that auditors are carrying out that vital process with due attention to the relevance of climate risk and climate opportunity and how that's reflected in the report and accounts. So the opportunity for engagement and for proxy voting is right there, and it's time for us to take that opportunity. Now, it's not just investors working individually and on their own. We also now have Climate Action 100 Plus, which CalPERS co-founded and where Ceres is playing a wonderful role supporting this initiative. And we have made governance, setting targets, and disclosure the three-part plan to achieve that net zero goal where we all need to head. And the important thing here is that in the disclosure that we're looking for, we need to ensure that that disclosure is being made on the basis of sustainable assumptions. And that means we can't ignore accounting, and we need the protection for audit office as well. So I think we're moving to a very dynamic, a challenging, but very important stage in engagement. But it's where that, sleepy old world of accounting and audit we're going to find is actually central to the financial markets playing their proper role in the allocation of capital and in stewardship through proxy voting and engagement to make sure we not only manage, mitigate, and address the risk of climate change, but that we also find the opportunities that are there for us in this transition. So thank you.